Time now for an in-depth look at the market news this afternoon, and for that, I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, hope you had a happy Christmas. Thank you for coming on today.
Happy to be here.
Last Thursday, ahead of the Christmas holiday, we saw a bit of a Santa Claus rally on Wall Street. The Omicron variant is still spreading fast, but there seems to be some relief out there that the symptoms aren't too bad, and so some countries are going to avert another lockdown. And as we come to the end of the year this week, what's the story in the global markets?
Okay, well, after a large decline from 15th to 20th, which was last Monday, that was attributed to the rise of Omicron and the shutdowns in some European countries to limit the spread of the Omicron variant. All three indices made a comeback from the 16th to Thursday. The U.S. markets were closed on Friday because it was Christmas Eve, but it was a fairly strong week for them. All three indices rose from Tuesday to Thursday, reaching above or near the high levels that it had been on the 15th. S&P closed at a historical record. For the week, Dow gained 1.6%, S&P gained 2.3%, NASDAQ gained by 3.2%. It's interesting to see that airlines and cruise liner stocks, which had been hard hit by the coronavirus, were part of the stocks which were supporting the comeback. Its prices rose. And then the U.S. Personal consumption expenditure inflation numbers were revealed last week as well, 0.6% for monthly for November. And looking at it year to year, core PCE inflation was 4.7%. That was higher than expected, but the market seems to be shrugging that off somewhat. The European markets were broadly following the U.S. markets, making a comeback from December 20th, but today, some of the European markets stumbled a bit. DAX was up, FTSE and CAC were down on Friday. And then the Asian markets, they also generally joined the increase from the 20th to 21st. But today, they're showing somewhat different results market to market. Nikkei was down today, Shanghai was up slightly, and Hang Seng was up.
Well, we're seeing strength, as you say, in the U.S. markets, but today it was a mix here in Korea. The KOSDAQ was higher, but generally the indices staying in the range they've been in. Tell us about the domestic market.
Okay, well, Kospi, again, like the U.S., it rose from the 21st to 24th, but it was down very slightly today. But it did fall below 3,000. 2,900. It ended today at 2,999.55. It was down 0.43%. Individuals sold, institutions and foreigners bought. But foreigners, even though they did end up on the buying side, they only bought very small amount, 43 billion won's worth of stocks. Generally, the trading was thought to be small because it's heading toward the end of the year, and trading this week is not likely to be grow to a large size. Either they're going to probably wait out the new year. We will have no trading on Friday. The trading year will end on the 30th. KOSDAQ, it rose from the 21st, but unlike the KOSPI, it did rise today as well. It ended today at 1,011.36. It rose 0.39%. Individuals sold, institutions and foreigners bought. But again, foreigners bought very slightly at only 53 billion won.
Well, Professor, if we could look at the car industry specifically, this year Korean automakers have seen production fall to the lowest level since 2004, with annual unit production stuck below 4 million, and it's possible this could continue into next year too. The chip shortage is a major factor. What do you see happening in the auto sector?
Okay, well, production for 2021 was 3.48 million. That was down 0.85% from last year. This is the first time since 2004 that production ended up below 3.5 million units, and the production right now is even below the low levels that we saw during the global financial crisis. And this is a 3 straight year that the Korean production is below 4 million. But there's a big difference. 2019 low production was due to weak global demand, and 2020 was due to somewhat weak global demand as well, though it picked up greatly toward the end of the year. But in this year, the global and domestic demand is actually fairly strong. So the reason for the lack of production is not because people cannot afford cars, but cars just are not available, and the big reason behind that is, as you mentioned, no semiconductors. Globally, lack of semiconductors is attributed to reducing global supply of automobiles by about 10 million units, and European, American, and Korean manufacturers, the factories halted production for several days in several times during the year because these semiconductors were not available in the United States and in some parts of Europe. They've gone as far as selling cars without some of the options or even some of the features because the semiconductors controlling those features or options are just not available, and people would rather have their cars quickly without those features rather than wait until the semiconductors become available. Now, by most international analysts, demand have actually risen this year. Some analysts believe that it went up as much as 3.2%, but again, cars are just not available. This is shown in the prices for cars, especially in the United States where the demand has been strongest. U.S. car prices over the last 12 months, new car prices have gone up by 11.1%, but the used car prices have gone up a whopping 31.4%, and the used cars component is a major contributor to the high U.S. inflation. Used car prices are going up higher than new cars because, well, for new cars, companies like to keep prices under somewhat of a control to maintain customer loyalty, but used car market is a completely free market, so people who cannot get new cars are just going into the used car market. Korean new car inflation is not that high, but still, it is rising. So it all depends on when the semiconductor shortage will end. A lot of people expected the shortage to end around now, end of 2021, but this shortage is lasting longer than expected. It's because the global increase in demand has caught a lot of manufacturers by surprise, but it actually turns out to be good for car manufacturers because they don't have to drop prices to compete. So companies like Audi, Mercedes-Benz, and even Korea's Hyundai have been making fairly good profits, but it's a more serious problem for smaller Korean companies like GM Korea, Renault, Samsung, and SsangYong because their production size was low even before the pandemic, and now it's going to be even smaller. We don't know if it'll be enough for these companies to maintain survival because the volume may fall too low. And these companies face a longer-term problem as well. They're going to have to switch over to electric cars eventually, and we're not sure whether they'll have the capacity to do that. So the semiconductor shortage may actually turn out to be good news for larger Korean producers, but not for smaller ones.
Well, Professor, before we go, just briefly, what's on your radar in the week ahead?
Okay, well, on Tuesday, we have consumer sentiments, including the inflationary expectations, and then state of small businesses report. On Wednesday, we have the business sentiment report for Korea and population movement report for Korea. That'll have implications for housing markets. And then Thursday, we'll have November industrial activity trend report, which shows consumption, investment, and production for November. And for Korea, at least, the big statistics for the week is going to be on Friday, December, and annual consumer price index inflation. For foreign statistics, some interesting ones are U.S. consumer sentiments, U.S. housing price index, and U.S. trade account and oil reserve figures, which will be available sometime next week. That'll give us a look at the international trends and whether the recovery will continue or whether it'll be hit by the Omicron variant.
Got it. All right, Professor, we'll have to leave it there for today. Thank you, as always, for sharing your insights with us. We appreciate it.
Thank you.